This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
With us around the table, you've got a sneak peek of this. Andrew Balls, Global Fixed Income CIO at PIMCO. Andrew, good morning.
Good to be here. Thanks very much.
10-year, fantastic to be with you. 434 on a 10-year yield this morning. To build on what Lisa said, is this a moment in time, buy, lock it in before it goes away, or can we live with this?
So I think it looks pretty attractive. We're in the middle of our forum discussions, which we had in London as well, actually. So we're still talking about this with the investment committee.
Give us a head start.
But it looks pretty attractive here. If you have a high quality bond fund, 5-6% yield in US dollars with more credit, kind of 7%, maybe 7.5% yield, this looks very attractive. Equities have done very well this year. Looking forward, 6.5%, 5.5% type yield for a bond fund looks very good to us.
There are 2 points here. One is, does this look attractive now? And the second is, where is the next rate? Where does the move come from? Is it higher or is it lower? There are two different discussions, right, and how sticky this is going to be. How big is the argument right now in some of these meetings at PIMCO?
Well, I think you were talking about real yields and I was nodding. When you look at real yields and look at long-term history, it's starting to look attractive here. We had this period after 2008, quantitative easing and all of that, and depressed real yields. But you're now seeing real yields at attractive levels, and nominal yields I was quoting before look pretty good to us. You have, in the outlook, you have inflation still stubbornly high at the core level, improving much faster in the US compared with Europe. But I think the jury is still out there. But then don't forget the recession risk. We have had very significant global tightening across the world. And yes, the data has been better than expected, particularly in the US this year. But as we all know, these central bank tightening takes time to feed into the real economy. So looking forward, the jury's still out on inflation, but that recession risk remains significant.
Critical question for PIMCO, and it's not only the heritage of PIMCO from Bill and Mohammed forward to the great call you people made a number of years ago. You've got the advantage of the former vice chairman, Richard Clarida, I believe, darkens the door. I can just see Balls and Clarida in a debate over where we're going to reset on our start and almost on a global R start. Do you sense within all the great work you do, Andrew, that we're going to reset at a new rate regime, something that we've never experienced before?
So I think it's an interesting debate. Rich and I tend to agree and on this point that as you look forward beyond this inflation episode, the cyclical rise in policy rates we've seen, there's good reasons to think that R-star neutral rates are at the low levels that we've seen for the last several years. We'll see this in the Fed's projections this week, but the chances are the Fed will also see 2.5% as their long dot. So compare the 4.5%, 4.3%, 4.4% for the 10-year Treasury, or look at the forward rates and compare it with that neutral anchor. We believe that anchor remains the correct way to do the analysis, and then the long-term outlook versus that then looks very attractive, I'd say.
Does Lagarde have an R-star? Does Ueda have an R-star? Dare I say, does Bailey have an R-star?
They all have the variations on this. I think the Fed maybe is a bit happier to talk about it sometimes. But again, looking at bond yields now, even in Japan, you are getting to levels in terms of the 10-year yield where it's starting to look more interesting. Control for volatility, return per unit of volatility.
I agree with that. This
and
is really
it becomes a little bit once we get beyond the YCC, once we get beyond the yield curve control. So if you think that you have that anchor, and we do, then look at your five-year forward rates to isolate the long-term expectations beyond this central bank cycle. And that's the environment when it's much easier to come in and be positive like I am today compared with the lows of the COVID period.
We don't spend nearly enough time talking about this. how different this regime is to the regime of the last decade before the pandemic. How different is it for you and the team? What have you had to change just in terms of your approach away from zero rates and QE forever towards potentially the Bank of Japan hiking interest rates, the ECB going to levels I never thought they'd get to? I thought maybe they'd go back to zero, but here we are at 4%. How different is this for you and the team?
Well, I think it's very different, and I think as a bond manager, you like to see these high yields at the front end of the curve. It becomes really interesting, the relative value at the front end of the curve. You know, zero yields. Remember those. Something that hopefully we've consigned to history. I think one important thing looking forward, different to the last 10 years, is uncertainty around inflation. So we see inflation coming down towards central bank targets, a little bit above, but coming down over the course of next year. But I think clearly there's much more uncertainty in the inflation picture for the next few years compared with the last decade. And so back to the discussion before, you should be getting term premium. You should be getting paid appropriate term premium for holding the 10-year part of the curve. But again, comparing our forward rates with our expectations for our start, it looks like you're getting fair compensation after a period when, with quantitative easing and all, the risk premiums were really compressed.
What about in credit, though? I mean, given the fact that you're looking at greater vulnerability to an oil price shock or a unionization shock or a technological shock, some of these things that become that much more important when your cushion is that much smaller.
So I think the baseline for credit looks fine. I think credit should do well in an environment where you avoid the tails, not just about recession, but real recession, not just a technical recession. And on the upside case, if inflation is coming back into line with that fairly benign middle path, then credit should be fine. From our perspective, though, we want to guard against the tails. And if we do get deeper than expected economic downturn, that's going to be painful in credit. So I think up in quality, IG looks attractive versus high yield. Avoid cuspier credits, avoid any kind of exposure to real default risk in what remains a really uncertain environment. It's not often you have these sorts of tightening cycles globally to such an extent. And then the final thing, there's lots of other stuff we can do in the world. US agency mortgages, very, very high quality instrument, very attractive in terms of the valuation. So again, if you can get to the kind of 5-6% type yields on core bonds, that looks pretty good to us in terms of the next few years.
Andrew, always a privilege. Thank you, sir. Andrew Balls there of PIMCO.
What we're going to do right now, this is really important. We're trying to piece together, with the trip to London, the credit conference we'll be doing on Thursday, we're really trying to piece together 2024. They're the political conventions in America and that. But front and center for Bramo, John and myself, is we need tickets to the Paris Olympics. The only reason he's with us now with AXA Investments Paris, Gilles Moec is with us here. Give us an update right now on Mr. Macron, AXA, and the Paris boom you're going to see. Can Paris get any more boomier than it is now off the Olympics next summer?
Right, it's looking good. I guess tourism is helping a lot. So yeah, I mean, the city is having a good run. Gas is going to continue until the Olympics. Now the country around Paris, it can be a bit more complicated. We've had a good first half of the year. Things are starting to look a bit more complicated. So there's a lot of positivity at the moment in France, because if you compare yourself to Germany, things are so much better. Right. Even the German Stellar stopped now, so it's quite unusual. But actually, if you look at the latest business confidence survey, it's not as bad as in Germany, but it's also heading south.
This is really important, because I think to our listeners and viewers, particularly in America, when we say we went to France, we went to 3 arrondissements wrapped around Notre Dame and the wonderful repair of that cathedral. We don't have a real picture here of the greater European economy. We just see the boom of European tourism. Separate the European tourism from your caution on the rest of the European economy.
Yeah, I mean, the definitely the weakness in the euro is helping from that point of view. So tourism is actually a function of that weakness, the rebound in the US, I think the appetite for traveling to Europe at the moment. But even in the most tourism-sensitive countries in the Eurozone, it's 15 to 20% of GDP at most. And the rest is the usual stuff that is dependent on either world demand in the generic sense of the meaning, or on consumer spending. And consumer spending in France, for instance, has been contracting for 2 quarters in a row. So we have to be, a bit broader in our assessment of the situation.
It takes us to the ECB, so let's be slightly provocative in this question. Trichet 2008, Trichet 2011. Should we add Lagarde September 2023 to those?
Well, they're trying hard not to fall in that trap, because actually if you compare this with 2008 and with 2011, there was not a great sense of caution at the time when they actually hiked. There was a sort of self-righteousness that we are definitely delivering what we need to, and we're probably going to continue. Whereas this time it feels very much like it's the last hike that we probably need, maybe for tactical reasons internally, to get the hawks on board. Also because I think it's true there is a resilience of inflation which is more tangible in Europe than it is in the US. But the entire body language from Christine Lagarde last week was about, yes, they're now selling the long for, the high for long, but in terms of further hikes, we're probably done. And I think, yes, what happened in 2008, what happened in 2011 must be on their minds. And even the hawks are getting a bit less vocal, I would say.
I've noticed the same thing. It begs the question about what we can learn from the European experience on the other side of the Atlantic. Do you think there are any lessons? You see Germany essentially go into recession and inflation's still a problem. Growth in Europe essentially stagnate and inflation is still a problem. Is softer growth the cure for what we're experiencing at the moment?
Well, I know that lots of economists, including myself, have been wrong on that for the last year, but history would tell you that it's very, very, very hard to get disinflation without proper pain in the real economy, especially when inflation is no longer about exogenous forces, it's about your domestic forces. So as long as proved otherwise, I would say that what's happening in Europe is probably a lesson for what might happen in the US, even if, yes, the US resilience is amazing at the moment. I guess a big difference between the two is that there's, I think, in Germany a more structural issue, which is coming back to bite them at the moment, which is to some extent, disconnected from monetary policy. They would be probably in a softer patch anyway, and that is dragging the Eurozone average down. But you want to kill inflation, especially when it started to get entrenched in wage negotiations. You probably need to engineer some sort of softening of demand. There is not a lot in the textbook that would tell you otherwise.
Is Europe completely different than the U.S. when it comes to how well it can withstand the oil shock, or just perhaps the oil prices going back to something more normal on an inflation-adjusted basis?
Well, our big problem for the last 2 years has been gas rather than oil. But on average, we tend to be more sensitive to oil shocks than the US for complicated reasons, due to the fact that even if we are less oil intensive than the US, the actual price of a gallon of gas in Europe is much higher than in the US, and people are probably more sensitive to that particular item. But if it was just about oil prices, I don't think we would be really concerned. I think most observers at the moment are more focused on what's going on with food prices. Hopefully it will continue to slow down, at least this is what wholesale markets would tell you for most of that, and gas. And we went through last winter much more positively than what was expected. We need to do it again this winter, and to some extent it's beyond our control.
Which feeds into the whole discussion of wage spirals, especially in light of some of the labor movement that we've seen in the US, but also around the world, maybe taking a page from Europe, if anything. Yeah. How much do you think that that's more noise than signal, or vice versa, in terms of wages staying sticky and labor power continuing to be stronger than it has been?
No, I think there's something profound happening there, which is that there has been a change in the balance of power between employees and employers. I mean, it's very trivial to say that, but in Europe, where we have in most countries a collective wage bargaining system, what we tend to have is more inertia in the way wages react. I mean, in the US, you could make the case that wage accelerate when people actually can leverage the job opportunities and go back to their employer and ask for a pay raise. It's not really the way it works in Europe. I mean, some of it obviously happens, but most of the pay increases here happen as a result of collective bargaining. And it always takes a while for instance, the unions to realize that maybe the economy has become softer, job opportunities are falling, maybe it would be time to move back towards wage moderation. But you need actually a proper proof that the labor market is softening. And even in Europe, and that's actually one of the big positives of our current situation, is even in countries which have been used to mass unemployment for decades, the current situation of the labor market is more than okay. I mean, take France, my country,
right.
Unemployment rate at 7%. If you had told me that France would be able to deliver that 10 years ago, I wouldn't have believed you.
I got 8 ways to go here, but just because of time, then can you state Europe is vaulted beyond Eurosclerosis?
I mean, eurosclerosis is, I think, in many cases, what we have is sort of a magnified version of what happens in the US in terms of demographic changes, for instance. We are a sort of more acute version of what is going to happen in the US anyway. But one point on which I think Europe at the moment is doing better than the US, it's on participation. The big positive right now in Europe is that our participation rate is rising and has been rising through the pandemic. It's today much higher than it was before COVID. It's exactly the opposite of what's been happening in the US, even if there has been a catch-up recently. We've put more young people, more older people back to work. And basically, I think we are benefiting from structural reforms which have been pushed through in Europe for the last 20, 30 years. Not spectacular ones, but gradually, I think we have a much better functioning labor market than what we had 20, 30 years ago. And it's definitely positive.
Gilles, that is a bright spot. Thanks for being with us. Gilles Moec of AXA Investment Managers. Geoff Yu joins us now, Senior Market Strategist at BNY Mellon. Good morning, Geoff.
Got a British accent.
It's good to see you. Yields at 5% at the front end, pushing cycle highs on a 10-year. Dare I say it, is this the new normal? Are we getting comfortable with this?
Well, let's go back to Tom's point about real yields, okay? You can deflate via CPI, headline CPI. What if we deflate nominal yields by wage gains or potential wage gains? So then if you take the 20% or between 20 and 40% real wages, nominal wage gains, if realized, then real yields actually are very, very negative still, and then central bankers have to catch up. So there's a risk here, going back to your point about a wage price spiral that isn't going away anytime soon.
What is the x-axis on real yield? So here we are at 2%. I've done some fancy math. I get to 2.20. Maybe I'm still here at 2%. Whatever it is, there's a length of this new real yield. Where's the tension point out into next year?
So basically you have to identify where potential GDP growth is, medium to longer term growth in the US. If that's a headline number, nominal number, 3 to 4%, then find your inflation target. Then if it's still 2%, right, then real yields you still need to get to 2 to 3. Right.
To go nerdy on a Monday, R minus G, are we at a risk here where the interest rate becomes less than the small g, as Blanchard and Stiglitz, among others, worry about?
I'm glad you brought up Blanchard because I want to bring up another paper between him and Chair Bernanke.
Yes,
when does this become a problem?
Such a nerd fest over on the port side of the desk.
Favorite part of the morning. In terms of wages versus price spiral, and with the oil prices going where they are right now, you get a price spiral according to that paper when labour markets are tight. Yeah. So here are the unions making the gamble or the determination in manufacturing, labour markets are still very tight right now in the US.
Which raises a question, is this signal or noise? Because this is, yes, it is now tight. Although on the margins, you're seeing signs that you are getting some sort of labour market softening. Right. Is this the last gasp, as John was asking, of labour market power? Or is this something else that does have a stickier nature?
I'd say on a broader basis, this does feel like a last gasp if I look at things globally. But on the other hand, I'm an FX guy at the end of the day. Relatives, it's all about the relative differentials. I think US labour market's still or tighter compared to what we have in Europe right now. So on that note alone, probably Labour has more bargaining power in the US compared to in Europe.
Does that mean dollar weakness?
I would say, a short-term, dollar strength, that's still going to be in play because that puts the Fed on a more vigilant footing, to borrow an ECB phrase. But net, I think pretty much that is in the price right now. So let's see where we're going to be.
Very cliché of you, Geoff. Let's talk about Powell on Wednesday. On Wednesday, we get a set of projections.
Yep.
Most people assume that for 2023, when we look at revised growth figures, they're going up.
Yep.
When we look at revised inflation figures, they're going down. What does 2024 look like for you and the team?
Still 2024, it's less about are they going to hike further. It's more about how long do US rates stay where they are. And that is what the BOJ will be looking at. And what, so you didn't mention Central Bank of Brazil, Central Bank of Turkey, the Central Bank of South Africa, the Swiss, they're all deciding. And when they look at their nominal effective exchange rates, they'll all be looking at the Fed. How long can the Fed's projection keep the dollar strong? And then they'll have to calibrate their own forecasts accordingly.
Is that dollar problem bigger in Europe right now for you than EM?
I think that dollar problem is bigger in Europe because EM across the board, if you look at Brazil, for example, much higher real rates. So they've got the buffer, Europe does not.
Georgieva surprised us with a low 5-year growth view. Suddenly, oil 94. For Geoff Yu, where is the price of Brent that's a tip point that really accentuates that global slowdown?
Let's look at the individual markets. For example, China's at a slowdown already, no matter what China, unless you're looking at a real re-acceleration in China, which is not my base case, to 5 or 6%, then you get into a demand issue on top of a supply issue. That becomes a problem globally, and then that could be a tipping point. But right now, if it's just the US alone, and given US energy independence, I think it's much more manageable.
I'm glad you mentioned China. The Wall Street Journal had this big expose. China might be weaker than you think, and Tafak has talked about focusing on the housing market. Other people have said, including Leland Miller of the China Beige Book, that from a U.S. perspective, this is what people want to see, but it's not actually what's happening on the ground, that there's actually a great deal of strength. Having been in China a couple of times recently, what's your view? So
domestically, I thought consumption was firm. So I was there about 3 weeks ago. People were spending. Some of the key tourist sites, like in Xi'an, the Terracotta Warriors, was basically several rows behind before you could actually see the soldiers there. But then on the way out, look at Beijing Airport, just barely any international flights coming out. So that higher ticket consumption items, I think that's a bit more of a problem at this point. Going back to the real estate market, there's close linkages to the financial system in China. Stabilizing the real estate market means stabilizing the financial system, especially the trust and framework, shadow banking, for example. So that's where I think that they are doing the right thing. But ultimately, how much more downside can you price in relative pricing? I think it's very limited.
Do you partition China into domestic balance sheet challenges, even out to Chengdu, or do you drag that into the more international analysis of renminbi and the rest? Do you partition or not?
So I think at this point, China's pretty much self-financed. We look at our own flow data. International financing for China's growth is very, very limited right now. So it's about domestic financial stability.
I agree.
And then the transmission is, if things go awry, can that drag down international growth further?
We've got to squeeze this in, Geoff. We're in Europe. There is an EV battle taking place. And to a greater extent, I think the transition to EVs is at the epicenter, the heart of this conversation with UAW and the Detroit 3 at the moment. Are we heading towards just massive tariffs for auto imports in places like Europe?
If you asked me 2 weeks ago, I would have said no, but I think something changed at the Munich Auto Show.
What do you think changed?
I think for the first time in 3 or 4 years, Chinese came back and European manufacturers looked at how far they were behind, not just in terms of cars, battery technology, and realized this is much more pressing than we thought, and you saw the reaction.
German manufacturers are scared of what's coming out of China.
Absolutely. And China saw this in advance. That's why they want to build in Hungary battery factories, and they want to build assembly plants in France as well. But even then, with that kind of cooperative approach, you're seeing the backlash already, and then you're seeing the backlash from Beijing. So this is going to get interesting.
Now, this is only one industry.
Yeah.
But do you think there's broader things at play here that ultimately influence things like flows that contribute to causing foreign exchange?
I think medium to longer term, let's look at the chip industry as well. That's going to feature heavily in terms of flows into Asia, into Europe. But the importance to employment, especially in Germany, and also that Eastern Europe that feeds into the German supply chain.
Poland.
I think this is, and politically speaking, this is absolutely going to be central to Europe.
Geoff, this was fantastic. Great to kick off the week with you here in London. Geoff Yu there.
My pleasure.
Of BNY Mellon.
Right now, we're going to survive American politics. Gregory Valliere briefs us this morning, Chief U.S. Policy Strategist at AGF. Greg, in the Washington Post, they talk about 5 ideological factions of the Republican Party. I didn't know that. Do you actually buy the idea, given labor unrest in America, given a possible government shutdown, that Mr. McCarthy's dealing with 5 ideological factions?
Oh, at least. Yeah, it's quite a spectacle right now. He's on really thin ice, Tom. I don't think he can get a deal before the October 1 deadline. So we do have a shutdown. I call it shutdown light because it's not going to be the end of the world. We're not going to kill Social Security and Medicare benefits. But if you want to go to a national park, you're out of luck. And I think the shutdown is going to last for quite a while.
Is there a shutdown in Detroit? What I find stark is the imagery and the great coverage by Bloomberg on this. You know, I see them picketing and there's like 7 people out front. It looks like a lineup at Denny's waiting to get in. I mean, is this like a real strike of labor like you and I remember? Or is it sort of kind of like pretend?
Yeah, it's not like what we remember, that everybody went out and you didn't selectively target factories. But I think there have been some sign of progress. I think Ford has been the most conciliatory. And I think the elephant in the room, obviously, is Joe Biden. I think Biden knows that Michigan has 16 electoral votes. And I think Biden will be influential in the final agreement.
What will that entail? Do we have a sense of what it will take to get it done and what that means for the viability of auto manufacturers that have traditionally added to the GDP and really fostered a lot of strength in the Midwest?
Yeah, I think it will have to be close to 30% in wages. 40%'s out of the question, but I think the number will creep up. They may go back to more like defined pensions. They may have less than a 40-hour work week. It will be generous, and it will add to the perception that wages are sticky for the Federal Reserve. I think sticky wages are going to be around for quite a while.
Does this pressure, just sort of uniting the two ideas, does this pressure lawmakers to try to get a budget deal done just to avoid the extra hit on that front, especially at a time where there might be some agreement on things like border control between the Republicans and Democrats?
I tell you, Lisa, these people are on a different planet from you and me. They are fighting these parochial fights knowing they're going to lose. I mean, it's quite clear that this compromise over the weekend would never make it through the Senate. I'm not even sure it would make it through the House. So we're going to go through this exercise. And sadly, I think this drags on right into the holiday season, maybe after the holiday season, before we get a deal.
Greg, I got to turn to script. Once again, over the weekend, lots of discussion about the president's age. I think all of our listeners and viewers are sort of exhausted by the debate. But I want to know the Valliere timeline to where I get an LBJ announcement like March of 1968. You and I were sitting on the couch watching the Bruins lose when that happened. How do we get Joe Biden out to where LBJ was in March of 68?
I don't think he realizes there's a problem. And more Democrats I talk to, almost all of them, as a matter of fact, say they would like to see Biden step down. 2 problems. Number 1, he is delusional and he doesn't think there is a problem. Number 2, there is no logical successor. That's the problem for the party.
Do the polls scream, Greg, that there's a problem?
Absolutely. I mean, about 70% of Democrats say they would prefer a different nominee. I mean, I've never seen a gap like that. So you could have more pressure. You know, the other thing, guys, I should mention is that filing deadlines are fast approaching. By late October, early November, it's too late to file. So any talk about some last-minute rescue for the party, I think, is unwarranted.
Greg, before you go, have you heard about that missing F-35? Have you read the story on that?
The missing what?
F-35 fighter jet gone missing.
In the Carolinas.
Greg, what on earth is going on? How does the military lose an F-35?
I know, it's quite a story. And I think it's going to get bigger.
Greg Valliere of AGF, thank you, sir.
Let us move on. Amrita Sen joins us to save us here from the ballpark, co-founder, head of research at Energy Aspects, and critically joins us this morning from Canada. which is an oil producer. Amrita, within your racket, within your industry, are they looking at this as a surge that can ebb, or is there a feeling, within the macro petroleum business that this is a new pricing to stay?
Well, it's still early. It's not even 5 a.m. here, so I don't know how they're feeling. But if I had to guess, Tom, I would say they are all going to be very happy. I mean, of course, there's World Petroleum Congress over here. All ministers from all around the world are gathering, including Prince Abdulaziz himself. There's lots and lots of talks with both consumers and producer governments, really, over the next couple of days over here. And I think the reality is that demand has surprised to the upside, regardless of all the recessionary fears that we've seen. Right. And I think that's why what is interesting for me is, yes, crude is getting all the headlines now. We're talking about it. But if you look at products and crack spreads, that have already been high for the last few months. Gasoline, diesel, they've been trading at $120+ per barrel. Crude was 80. Now crude's catching up, but those prices haven't necessarily gone up further. So this is more of a redistribution between refiners and producers than really end users feeling the impact. So I know why the media is focusing on the crude, but I don't think the end user is necessarily seeing that big an impact versus a few months ago.
Right. What is a representation or tone of China is the marginal demand elephant in the room at the Congress? Is China there in a big way?
I think there is going to be presence, for sure. And I think, again, the dichotomy between Chinese macro and Chinese oil demand is definitely going to come up, something we've been highlighting for some time now, because in the West, and Western analysts keep looking at the Chinese macro data and saying, well, oil demand hasn't been performing yet. Oil demand has actually been hitting record highs because it's become more consumer-oriented. Plus, China's got some strategic petroleum reserve filling going on as well. In some ways, the US has been drawing it down last year, and China now is actually refilling it, having locked in some favorable prices earlier in the year.
What's the pressure on Prince Abdulaziz today, who's going to be speaking, I believe, around 10 a.m. Eastern time at the Calgary conference, to really increase production, especially if this is being driven in part by demand, not just their supply cuts?
Well, I think he's been very clear that, look, there still is a lot of uncertainty, be it from the Fed itself or even China, all the kind of noise that's coming around. And he has to be 1,000% confident, I would say, not even 100%, that there are not going to be any of these, surprises with the Fed, for instance. And it's a bit of a chicken and egg, right? If oil prices go up, what does the Fed do, as you guys have been talking about as well? But I think they are going to be cautious. They want to ensure that balances, or at least inventories, do not build because of those macro concerns. And look, Saudi Arabia has extended the cuts till year end. So has Russia. It kind of gives, for them, the main thing they want to provide is stability. And I think that's what he's trying to do. And I think that's what he's going to focus on today.
It's a really interesting confluence of events. At the United Nations, they're holding a conference right now where a lot of the focus is going to be on sustainable energy and moving away from fossil fuels. You have electric vehicles taking over. That is underpinning some of the discussions with the UAW. How much is that underpinning Saudi Arabia's decision to cut production, to get more profits now before some of these groups phase out fossil fuels, before they become less of a focus later on?
Well, you could argue that goes both ways, Lisa, right? I've also heard the argument that that's why other countries want to flood the market and make sure they don't have stranded assets afterwards. I don't think OPEC plus policy works like that. We've written about this as well, that ultimately Saudi Arabia and most OPEC countries are revenue optimizers, right? What they are trying to do for themselves is saying, okay, if this is the price and we cut production or raise production, what is our total revenue going to be? That is what they are focusing on right now. Of course, they are concerned about long-term energy transition, but I wouldn't even use the word concerned. I think they embrace it. They are doing a lot around it, and they very much are aware that oil has to fade over time. They just disagree with the timelines like the IEA has put out.
What's the Amrita Sen timeline of an oil vector, I guess in June or July of 70-something up to 94.51 right now? Is that just a continued vector up? Do you see 95, 96, 97, et cetera, et cetera, et cetera?
Yeah, if you remember, Tom, our price forecast for Q4 was an average of $92 for Brent. So I think we've we've kind of hit it now. So the question is, but look, an average of 92 does allow oil prices to go to 100. We're putting out a piece later today, which is calling for $100 by Halloween for Brent. And again, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
The triple digit by Halloween, Amrita, is that just a marketing mechanism? Just, triple digits Halloween, or is there something about the next month?
No, it just rhymes, right? 100 by Halloween. That's why. No, I'm joking. But
nice.
No, I think, look, fundamentals are very, very strong right now, but also positioning. And that's one thing we shouldn't miss. A lot of hedge funds are very underpositioned in crude because of the macro concerns. Now we are seeing quite a bit of passive money come back as well. So I think the combination of that could actually lead to a temporary kind of upswing in crude. And that's why I'm not saying we're not expecting it to average above 100, but it could go above 100 in the next couple of weeks.
Only $5 away right now. Amrita, thank you. Amrita Sen of Energy Aspects.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.